The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning and a warm welcome to Squawk Box Europe. I'm Juliana Tattlebaum with Karen Cho, and these are your headlines this morning. President Trump's reciprocal tariffs are in effect, while India still faces the prospect of its levies being ramped up to 50%. And Switzerland's president leaves D.C. without a deal to bring down its 39% tariff.
Rheinmetall defense sales grow by more than a third in the first half of the year as the German arms maker capitalizes on growing demand from across Europe. Siemens confirms its full-year outlook as quarterly orders rise 28%. Although its key profit indicator for its industrial business drops 7% on the year. CEO Roland Busch tells CNBC the EU-US trade deal will allow the company to plan.
We would have reached lower tariffs. We are clear for global trade. But the impact on our Siemens businesses for this current fiscal year is minor.
A big realization today that we're not out of the woods on tariffs. Tariff stacking, a terminology that's come into the market, that just because you've got a baseline negotiation doesn't mean that is the ceiling. We're seeing that expressed through Japan and now concerns that could be spreading elsewhere. The latest here is that President Trump's so-called reciprocal tariffs have come into effect, putting sky-high levies on countries across the planet. The duties come into effect in just over an hour's time ago, now pushing US import levies to their highest level in 100 years. Switzerland is the worst affected country in Europe with a 39% charge on its exports to the US, more than double the rate imposed on the EU. President Trump took to his Truth Social website to mark the occasion, claiming there are now billions of dollars in duties coming into America.
President Trump hiked India's tariff rate to 50% after imposing an extra 25% levy on the country, citing its continued purchase of Russian oil. That new charge on Indian exports to the U.S. will come into effect in 21 days, dealing a severe blow to a trading relationship worth more than $190 billion. The move will put India among the highest tariff nations in the world. Let's get out to our colleague Shri, who joins us now with more. Shri, my question here is, if this is really all about Russian oil and India's purchase of Russian oil, why is India being penalized but China's not?
It's quite extraordinary, and maybe China will come in time. And it's something of a head scratcher, Juliana. Let me try and explain that. It's extraordinary, and you're seeing this play out in Europe as well. And Karen was talking about Switzerland. Extraordinary that Trump is adopting and shifting this change of strategy and adopting what seems to be a knives-out tactic and approach when it comes to India and Switzerland. And it's very hard to find, isn't it, a casus belli for this aggressive lurch towards trading partners that were once considered friends and close allies. For India, perhaps they were not moving fast enough in taking down what some in the Trump administration call Maharaja tariffs. Perhaps this may be even an attempt to dismantle the BRICS. So maybe, to answer your question, Juliana, China may be coming next. But ironically and paradoxically, it looks like the US-China trade relationship is moving in the right direction. Very different story to India, of course. Many feel that this is the opening salvo of what could be a trade war between the US and India. Markets, however, and the macro seem to be looking at it a little bit more optimistically. The benchmark Nifty shrugging off the prospect of ultimately 50% tariffs. And admittedly, the sectors with the most to lose, that's textiles, are down by more than 1%. Overall, though, I think it's the important takeaway. If there is a silver lining here, markets and many commentators that I've been speaking to are optimistic that there will be a negotiated settlement and the US will back off from 50%. Interestingly, yesterday, the RBI, watchful but affirmed full-year growth forecast at 6.5% and did not cut rates preemptively yesterday. So an element of keeping the powder dry. And if there's another reason to be not absolutely pessimistic about 50%, this additional 25% comes into effect in 21 days' time. So perhaps that is time enough for the negotiators, the diplomats to get around a table and start talking. Another very important date for your diary is August the 25th. That is when US negotiators are due in India. So perhaps there's going to be some furious back-channel negotiations going on here to try to salvage what is right now quite a shot relationship between the US and India.
Sri, thank you very much for spelling that. From India to Switzerland, President Trump's 39% tariff on imports from Switzerland is also now in place. This is despite Swiss President Karin Keller-Sutter rushing to Washington in a bid to secure a last-minute deal. She met with U.S. Secretary of State Marco Rubio, but did not meet with the U.S. leader himself or any of his top trade officials. And let's get out to Carolyn for more. Carolyn, the latest seems to be that the Federal Council of Switzerland will hold an extraordinary meeting this afternoon.
Yes, absolutely. That has been confirmed by the Federal Council earlier this morning. The Swiss delegation that was in Washington actually touched down in the capital of Bern roughly an hour ago. 2 hours ago, those tariffs kicked in at 39%. That is, of course, prohibitively high. So this afternoon, when there is a press conference information for the public, we might get a little bit more information what actually went down in the meeting with Secretary of State Marco Rubio. So far, we don't have a whole lot of details on that. So we'll want to hear whether any concessions have been made, whether any spending pledges have been made, any sweeteners have been given to the U.S. side. But of course, a big disappointment and political reputational blow to the Swiss President Karin Keller-Sutter, the fact that she did not meet with President Trump. Some will argue at least that Switzerland has got a foot in the door now for further negotiations. So some of them might still be holding out the hope that further down the track, another deal with a lower tariff rate can be struck. Will be really interesting to see how the market opens today, because over the last couple of days, the market has been pretty resilient here in Switzerland. Yes, yesterday it did fall to the tune of 0.9% as it became apparently clear that no deal was being struck. So keep an eye on the Swiss market this morning. We also got some reaction from some of the business lobbies, Swissmem, for the technical industry, saying if this horrendous tariff remains in place, it will mean the de facto death of the export business of the Swiss tech industry to the U.S. So a very big blow to Switzerland overall.
Carolyn, thank you for keeping us up to speed. We'll have more analysis on the state of things in Switzerland throughout the program. Meantime, there's also uncertainty surrounding tariff rates on Japan. Local media reports say the 15% so-called reciprocal levy will be applied on top of existing tariffs, including on cars. Japanese officials have previously said the agreement with the U.S. would see all duties reduced to the 15% level, with the country's top negotiator saying there would be no stacking of tariffs before his trip to Washington, which saw him meet with Commerce Secretary Howard Lutnick yesterday.
A lot of tariff uncertainty, but a lot of earnings crossing too this morning. Let's get into IHG and the hotels group posting numbers today, saying it will remain on track to meet its full-year consensus profit and earnings expectations. Also on track to return over $1.1 billion to shareholders, saying that while some shorter-term macroeconomic uncertainties remain, many are subsiding. Just a couple of lines on the RevPAR, the key metric for the business first half. Global RevPAR, 1.8%, Americas 1.4%, EMEA 4.1%, and Greater China minus 3.2%. Let's get to Ali Malouf, the CEO of IHG Hotels and Resorts. Ali, great to catch up with you. Thank you for joining us on Numbers and for being patient as we got through the latest tariff news. Just reading in between the lines, the RevPAR numbers look a bit light in the latest quarter. What did you experience, and how does that leave you now as you set up for the full year?
Well, good morning. It's good to be with you today. Look, we're pleased with our first half performance. As you said, RevPAR up 1.8%, our operating profit up 13%, earnings per share up 19%. And, there was great demand for our hotels around the world by our owners. We opened a record number of rooms across over 200 hotels, and we signed another 320 hotels. And importantly, we reached the milestone of 1 million open rooms around the world. So thanks to our teams for reaching this important milestone. And as you said, we're on track to deliver full year profit consensus and earnings per share consensus and return over $1 billion, over $1.1 billion to our shareholders. What we saw from the first quarter to the second quarter were a couple things. The first thing was mostly in the U.S. and in Europe, there was a shift of Easter from quarter to quarter, and that moved some business into the first quarter from the second quarter. And then the trade and policy turmoil of March and April affected some people's timing of decision making. We believe that uncertainty is subsiding. We're seeing more trade deals and we're seeing trade tensions. We're seeing record financial markets in the US and in Europe. We're seeing stable inflation and interest rates. So I think the conditions are improving as we go forward past the second quarter. But we feel good about where we're in the first half. We feel good about the long-term potential of the business. Our main industry body projects that this year, travel will contribute a record $12 trillion to the world economy. $12 trillion. We're very well positioned to get our important share of that.
Ellie, good to hear that you feel optimistic about what lies ahead. When it comes to the tariff uncertainty, we're just spelling out the top of the show. It just does not reduce from here. At this stage, we're still talking about confusion around tariff stacking and various different countries. If you were to pinpoint where some of the uncertainty has hit so far, is it the business or the leisure traveler? And what particular parts of the world are you seeing some behavioral change?
We saw growth in the first half in all of our main travel segments. We saw growth in leisure, in business, and in groups. We saw, good demand around the world at different degrees, but good demand around the world. I think what we're trying to do is compare it to where we were in March and April, sort of at the peak of the uncertainty. And back then, we said that we thought we were reaching the peak and going past the peak. I think that's pretty clear today. There are still some trade uncertainties, but you have more trade deals than trade tensions. You have good employment, especially in the US. Still record number of people employed, low unemployment. You have a boom of capital investment, private capital investment in technology, data centers, artificial intelligence. That's driving productivity in the country. You have a similar effect actually going on in China. And so we think that we're past the peak uncertainty. We think things are smoothing out. You have the new tax bill that was finally passed in the United States, which brings fiscal certainty. So there's always a level of uncertainty. What I tell our teams, Karin, is the only thing I'm certain about is there will be uncertainty. The question is, what is the level? We think we're past the peak and improving.
Well, Ellie, good morning. It's Juliana here. On that note, a lot of your peers have been talking about an acceleration in Q4 in growth and into next year. It sounds like, given you believe we're past peak uncertainty, you expect the same?
We don't give guidance by quarter or by year. Obviously, we watch the data and we watch the trends very carefully. We had a good first half of the year. We feel pretty good that over the mid to long term, we can continue to deliver it. I mean, look, 13% earnings growth, 19% EPS growth, record openings. We're pretty pleased with it. We're optimistic about the rest of the year. That's why we're confirming that we're comfortable with consensus profit and earnings per share, but we don't give guidance quarter by quarter.
Fair enough. Let me ask you a little bit more about what's going on in China. In Greater China, H1 RevPAR was down 3.2%. What's your outlook on the recovery in China?
Yeah, we've said for some time now that we believe China's bottoming out, and I think that's what we're seeing. Q2 RevPAR was better than Q1 this year. Q2 RevPAR this year was better than Q2 last year. I mean, it's a gradual bottoming out, but it's happening. And that's against the backdrop of the fact that we had record development activity in China. We reached over 800 hotels in the first half of the year. We're on our way to 1,000 in the next 18 months. We had record signings again, and we project that to continue. So our business is growing, and we have a very profitable business in China that keeps growing. When you step back and look at what's going on in the overall Chinese economy, clearly there's some weight on the economy, on consumer confidence from the digestion of the overbuilding of residential real estate. At the same time, it's a $20 trillion, very diversified economy. Other than the United States, the only other major place where you have a tech-infused boom of investment and productivity is in China. They're leaders in digital, leaders in electric vehicles, big players in artificial intelligence, and we're seeing that filter through the economy. GDP still grew over 5% in the second quarter this year. We just saw their export results this morning come out, over 7%. So they're finding a way to continue to export around the world, and that's maintaining some support in the economy. And then when you look long term, it's a middle class that's going to double over the next 10 years. 1/5 of the penetration of rooms, hotel rooms per capita than you have in the United States. So we're very confident about the long term in China.
Elliot, I want to circle back to the US numbers. The instinct tells me that the market's going to ask a few more questions about that RevPAR number. You have explained it away as the timing around Easter, but how much of this drop that you've seen in that second quarter? I mean, it's quite a significant shift, the 3.5% bounce you had in the first quarter to a drop of 0.5% in the second quarter. How much of that really can be explained around the Easter timing effect versus other strains in the business?
Well, we said it's two things. I said there was part of it that was Easter related, and that's well understood in the industry. And I said that there was an effect on business decisions and leisure decisions from the tensions and the uncertainty of March and April. And I said that we think we're getting past that. So I don't think it's just one factor. It's a combination of factors. But then when we sit back and look at the fundamentals of the U.S. economy, we got record employment, we got strong financial markets, we got GDP still growing, we got strong capital investment, we got certainty from the tax bill. I think you put all those things together. I don't know what the next quarter, the one after, is going to be like. I'm pretty confident about the mid to long term in the U.S. economy and our industry and our company in the mid to long term.
Okay, Ellie, if we can talk about the growth then. You've got some growth in some of the faster growing brands in the business, in the luxury space in particular, Voco, Garner, and also in that big luxury segment encompasses Intercontinental and Six Senses, among other brands. How is the luxury end performing versus the slightly lower end, more sort of middle category in the business?
The upper end has been very resilient. I mean, the luxury end has been the best performing over the first half of the year. We're pleased with the performance of all of our brands, but I'd say at the upper end, we've seen very good resilience. And, that traveler is probably more indifferent to changes in economic uncertainty in financial markets. Around the world, we saw very strong demand in our resorts and our luxury properties. But we're pleased with the performance of all of our brands. I mean, 75% of our hotels around the world carry the Holiday Inn name in one form or another, whether it's Holiday Inn or Holiday Inn Express. We've got a stay for everybody. But look, the luxury travelers are feeling pretty good, whether it's in Europe, United States, Asia. We're opening up a phenomenal collection of assets and resorts and in urban areas that are driven by Intercontinental, Six Senses, Kimpton, Hotel Indigo, Vignette, Regent. It's really a moment for us where we have a push into that segment, and the customers are very pleased with it.
Ellie, thank you so much for explaining the numbers to us today. Ellie Maloof with us, the CEO of IHG Hotels and Resorts.
Coming up on the show, Trump issues a fresh threat of tariffs on the chip sector, but U.S. investments could see some key players excluded. Plus, Chinese exports beat expectations in July, boosted by a continued U.S. trade boost, and earnings season continues across Europe. We'll hear from Maersk CEO Vincent Clerc after the break. Welcome back to the program. Maersk has upped its full-year guidance, saying it now sees EBITDA coming in as high as $9.5 billion, up from its previous forecast of $6 to $9 billion. This is the shipping giant posted a beat on second quarter revenue, which came in at $13.1 billion. The Danish group also shifted the bottom end of its global container market volume growth forecast higher, saying it now sees expansion between 2 and 4%. Well, Vincent Clerc joins us now, the CEO of Maersk. It sounds like business is booming for Maersk. Talk to us about what's driven the growth and what's led to your upgrade of guidance for the full year.
Yeah, thank you. It looks as if right now we have a set of circumstances, both with respect to how we're servicing our customers, but also on a macro basis, where we have a very, very resilient economy, strong growth. We continue to see container demand coming well ahead of expectations. A lot of it is driven by a manufacturing boom in China and strong exports pretty much everywhere in the world, except for the US during this quarter, where the tariff on, tariff off has had some dampening effect and landed us on a flat to slightly negative move. But overall, I think outside of the United States, we see a continued very strong demand, and that is fueling the earnings and the upgrade that we're able to do today.
It's fascinating that you're seeing such strong demand outside of the United States. How much of it is the result of the trade situation and diversion of trade and response to what's happening on the trade front versus, underlying fundamental demand for container shipping?
So I think what's really playing out in the last 2 to 3 years is a significant increase in Chinese market share of global trade. So we're seeing a manufacturing boom in some verticals. It's very known around the EVs, around renewable energy such as solar panels and so on, but also traditional retail and lifestyle and industrial goods that we have seen for a while. And we're seeing more and more of this being produced in China. So despite many of the talks about decoupling or China plus one, actually the reality on the ground continues to be that China is gaining market share. It continues to generate market demand across the globe. And this gain in market share seems to have accelerated over the last couple of years, which is then fueling this strong demand. US stands out in this. We went from something where at the beginning of the year we still had a trading regime that was pretty much the fruit of 20 to 30 years of globalization. And today we have tariffs in place that are probably the highest since the 1930s, and still a big unknown around where and how a trade deal is going to look like with China, which makes up most of the trade deficit that the US has today.
Vincent, that said, distortions seem to be a big feature of the trading environment. A lot of Chinese companies seeking to get ahead of those tariffs. I woke up this morning reading a report from Whirlpool saying that, look, most of the domestic production is really how they run their business, but they're up against it in terms of Chinese competitors sending product into the US to avoid those tariffs. Surely front-loading was a massive feature of these numbers.
Yes, I think that the big uncertainty today is really to see how, despite some of the tariffs and some of the trade deals being in place, it's really important to see now how China is going to play out, because there is a big shift that is going on from China manufacturing for Western brand to China actually exporting their brand and their finished products outside in the global world. That's fueling that growth that we just talked about, but it is also still playing out into the US, where you have a large push also from some of these Chinese brands to get in ahead of tariff and try to protect themselves the best that they can, given the uncertainty that there is for what is going to happen past the truce that there is for these 3 months.
Point around uncertainty, Vincent. Today, as we sift through the latest news flow, we're talking about tariff stacking, that some of the baseline rates actually are not baselines. In fact, we have no ceiling really applied here, that tariffs could be unstacked on top of other tariffs. It's left a lot of negotiators with a sense of dismay, particularly in the likes of Japan, for instance. What do you think that's going to mean for the uncertainty from here, as it feels like we're not getting to a deadline, then getting certainty? These deadlines just keep getting extended and negotiations just can keep on going on from here.
Yeah, I think one of the things that for us, if I look at the medium to long-term outlook, is certainly a concern is the lack of certainty. One thing is having to deal with baseline tariffs or a tariff regime that you can count on when you're making investment decisions or when you're making strategic decisions. But what we feel from a lot of our customers is actually that this uncertainty is causing a delay in investments and could on-site have an impact on global growth and global demand as people are waiting to see what is the right decision given the regime that there is. So for us, I think what is really important is to see that level of uncertainty with respect to tariff regime come down, have some of these trade deals be implemented and be stable for a while so that companies can go back to looking at how do they optimize and manage their business within this new phase of globalization.
Vincent, in terms of the softness in the U.S. relative to the rest of the world, can you give us a little bit of color on what industries are at the heart of that weakness here?
It's actually pretty broad-based. So when the tariffs were on at the beginning of the second quarter, we saw somewhere between 35 and 40% drop in demand almost immediately, as a lot of our customers kept a wait-and-see approach to the tariff and to see if they were going to go away. They escalated very quickly. You'll remember, as the truce was put in place, a lot of this started to move, but underlying actually the buying behaviors from a lot of the buyers in the US was affected, and they held back on buying more goods. So what you're seeing today is probably an inventory correction has started to play. Whether this is a sign of weakening demand in the US or simply a sign of inventory adjustments as people are trying to deal with this uncertainty and figuring out where their goods should be coming from, given that uncertainty, I think this is something that we will look at with a lot of interest in the next couple of quarters.
Vincent, to future planning, if the US president is successful in his aim to bring more manufacturing back to the United States, it means fewer goods being put onto ships sailing the high seas. If that is the case, it means you clearly need to gear up in the US market, surely. How do you think about the end game? Is manufacturing coming back to the US, and do you need to alter the business model?
I think for us, I want to say that in two ways. From a container perspective, you have about 50 to 60% of what we move in our containers is either foodstuff, raw material, or semi-finished goods that you would have a really hard time displacing or repatriating. And then you have 40% that is true manufacturing. A lot of the focus right now is actually on key commodities, chips, technology, and so on, that have strategic importance for national security and other consideration. And they represent a fairly small amount of what we're moving. So I think from a container market perspective, this, for the first, is going to take a long time. And second is actually the efforts are very focused on areas that are not necessarily big commodities for us if we look at what's in the container. Then our strategy of diversification and moving into logistics and supporting our customer supply chain is becoming increasingly actually mode agnostic, because irrespective of a localization within North America of the supply chain or having a longer global supply chain, logistics is getting more complex as these tariff regimes and geopolitics and changes emerge. And it means that for us as a company, there is a lot of opportunities to play a bigger role and unlock more value for our customers, which will be a source of growth in the medium to long term.
Lastly, can we wrap up on freight rates and what your outlook is for the second half of the year?
Yeah, so we've seen, as a result of this volatility that is mostly caused by the strong demands and the uncertainty on tariff, we've seen actually that the spot market on freight rates ended the quarter 37% above where it started the quarter, which actually generated a lot of positive momentum in our EBIT in the quarter, but also means that we're entering the third quarter and the traditional peak season with a much stronger pricing environment than what we had anticipated, hence the up on the guidance. After that, we'll have to see how resilient the demand continues to be into the fourth quarter. But this is really, I think, for at this time, a favorable pricing environment, volatile but favorable.